made some comments that you think that Congress ultimately will have to do it. What do you think, to the extent that it should be regulated, how would you do it? What are you thinking?
Well, so you're right. I was honored to teach not just one, but a multiple levels of different courses in financial technology and in cryptocurrency and blockchain technology. I think to the extent something is a security, the SEC has a lot of authority, and a lot of crypto tokens, I won't call them cryptocurrencies for this moment, but crypto tokens are indeed securities. The prior chair had indicated that. The prior SEC brought numerous enforcement actions to sort of bring some of those security or investment contract tokens into the rules. But there are some, like Bitcoin, if I can just focus on that, and that's about half of this $2 trillion asset class right now. It's a digital, scarce store of value, but highly volatile. And there's investors that want to trade that and trade that for its volatility, in some cases just for it has lower correlation with other markets. I think that we need greater investor protection there. And we don't have a federal regime overseeing the crypto exchanges. So if an investor wants to trade on that Bitcoin, understanding it's highly volatile, highly speculative, but if they want to trade on that we have in place some investor protection. And that's what I was saying, I think, is a gap in our system right now.
But it's a gap in our system that needs to be addressed by whom? Is that something that Congress will have to address? Because it's very possible Congress won't address it. And if they don't, is that something that you think you have an angle to address?
Well, I think that as it relates to Bitcoin, and I'm not speaking to all the other tokens right now, but as it relates to Bitcoin, while our sister agency, the Commodity Futures Trading Commission, has some limited anti-fraud and anti-manipulation authority, there's no federal authority to actually bring a regime to the crypto exchanges. Whether it's stock exchanges or futures exchanges, there's regimes that were put in place in the 1930s to help protect against fraud and manipulation on the exchanges and protect the integrity of that. And I think that's really something that we'll be working with Congress, and if they see fit, to try to bring some protection for people that want to invest in this speculative asset class.
In terms of that protection, though, how do you think of the role of social media? I mean, this goes back to GameStop, but also you're seeing it in crypto. Elon Musk is going to be on SNL this weekend. We've watched Dogecoin nearly double over the week, as people speculate that he's going to do a segment or a skit around that. He's been on Twitter talking about these things. What do you think of the celebrities taking to Twitter? We're looking at a tweet right now. Let's find out how live Saturday Night Live really is. And literally just on the backs of these kinds of communications, you're seeing stocks move, you're seeing crypto move. When you think about investor protection, what do you do about that, if anything?
So I think that we've lived, every decade we get new technologies. There were debates 100 years ago whether to allow a telephone on the floor of the New York Stock Exchange. And here we're in the 2020s. We need to update and freshen our rules to ensure that while retail investors and any individual has First Amendment rights to speak and so forth, that they're not misleading the public, they're not manipulating the public, manipulating the markets. In the securities field, we have a lot of authorities to do that. In a number of these crypto fields, not so clear if it's Bitcoin, for instance, which has been deemed not to be a security. But I do think that we're going to be freshening up our rules and really hearing from the public. I think that the community and the social media is good, but let's recognize also that now computers can train on that social media, do something which is called sentiment analysis. This is computers watching our words. In fact, this interview right now probably is being interpreted in sentiment analysis, meaning a computer somewhere is taking Andrew's and my words and saying, what does it mean for the markets? Now, the stock market's not yet open, but what does it mean for the markets?
Hey, Gary, I don't know how far you want to to go on this. Just take yourself away from SEC chair for a second. And just as a guy who taught courses at MIT, and I guess you didn't teach a course, you didn't call the Bitcoin or crypto course Ponzi scheme or tulip mania, or it was on crypto. So, and we have a lot of uninformed opinions. People call it a Ponzi scheme. People say it just takes the greater fool theory. Someone has to pay for it. There's no inherent value. Just as someone who knows how it works, you called it a store of value. Were you just referring to that as a perceived store of value? Or in your view, is the mechanism itself, does it imbue Bitcoin with actual value that people now ascribe to it, that it's similar to digital gold, in your view?
So I think what's important at the SEC is to be technology neutral and still stay to our core principles of protecting investors, capital formation, and those efficient markets. In that sense, and working with Congress, I'm saying I don't think there's that investor protection for Bitcoin investing at this point in time. Now, how has it been perceived by investors, and what did I teach at MIT before this, is that it's a digital, scarce, speculative store of value. It could go to zero or it could go high, and that's the nature of it. But I think bringing investor protection to that market is relevant if this is going to continue. And it brings confidence and trust to investors in overall markets. We found that in the equity markets. We found that in the bond markets, that when we bring investor protection to those markets and we try to our best within our resources to tamp out fraud and manipulation and other bad actors, that's good for capital formation.
Gary, it's on some corporate balance sheets as a alternative to cash. And, you know, when I hear Fed Chair Powell or Treasury Secretary Yellen talk about it, I hear one thing, which would make me think you'd have to be absolutely insane to put hard-earned corporate dollars, a cash manager, to put it in that. Can you give us any more than it could be worth zero or it could be worth $1 million?
You know, I know I'm Joe. There are other guests. You're going to have one for the next 4 years or however long I'm graced to be in this job. I'm not going to speak about valuations. That's your other guest.
Just figure MIT, you'd know whether blockchain is for, I figure you'd give it the slightest little bit of an endorsement. I'm not going to get that.
I know. I got the tease that you're trying to give me, but it's not my job right now. But what I would say is important is disclosure. You mentioned corporations. Disclosure, that's been our hallmark for 90 years of our capital markets, that a company discloses what's relevant to investors. And we're also, it's critical that whatever that disclosure is accurate, not misleading, and doesn't leave out material omissions.
Hey, Chair Gensler, help us with this. And maybe I'm just curious actually about your philosophy when it comes to investor protection, because right now there's such a divergent view of what investor protection means. There's a lot of people who look at the interest in the markets and say it's really exciting that there's younger people that are getting in the markets, that hopefully they're learning about the markets, that this is going to help the markets longer term. There are people who say actually there should be less investor protection to some degree, and in fact that the investor protections that we've historically have actually not protected the retail, but they've always protected the establishment. You hear that all the time, the suits, if you will, and we've been criticized on this very program for talking about that, or for trying to quote unquote try to protect the investor the way we've talked about historically. How do you think about that right now? And also the idea that certain investors have access to certain types of products that others don't.
Well, I don't know whether you were commenting that I should take off my jacket and you guys aren't wearing one, but to your question, at the core, I think investor protection has helped economic growth. I think that investor protection has helped capital formation because it builds trust and confidence in our financial markets, and I think it lowers what's called the risk premium. It lowers the risk that somebody's defrauding the investors. Now, investors can take risk. That's at our core of our sort of public policy. Investors can take risk as long as they have that disclosure, all of those, what's called material disclosures from an issuer, somebody raising money, somebody investing, and that those disclosures be kept current, and they're updated, as we know, quarterly and annually and the like. That's how I think of it. I think about the exchanges where there's not that protection yet on the crypto exchanges, but on the exchanges to ensure that there's integrity and that if somebody says there's a bid or an offer, it's real. And then thinking about this market structure and these events around January's volatility, is it the most efficient market? Meaning, does it help lower the cost through a lot of competition? Competition and transparency is contrasted to darkness and concentration. So that's the balancing, but bring transparency and competition in markets. That's good for investors. That's good for issuers.
This one's a little theoretical. The biggest issue for regulators trying to see things before they happen, and regulations often are only put in place after there's a crash, after there's a fiasco, after there's a situation where people lost a lot of money. It's just natural because there are so many lobbying organizations, so many blocks that are put up to try and keep the system status quo and as it is. But if you were looking out there, if there's one or two things that you're most concerned about, we did hear from the Fed yesterday that they're concerned about asset prices dropping really rapidly as they've gone up so quickly. If there's one or two areas that you're really concerned about, maybe preventing things before there's a crash, before there's a big problem, what would they be?
Well, I think the heart of yesterday's testimony was trying to get ahead. Technology has been a good thing, bringing a lot of access. It's easier user interfaces on our mobile apps, not just in finance. That's generally been a positive outcome. But to guard against that, we don't lull ourselves into a place that we're not protecting investors and we're not ensuring for that market integrity that I mentioned earlier. So I think it's good working with the staff and my fellow commissioners to get ahead of that. I also think disclosure, that we're in a new decade and investors want to understand more information about climate risk and human capital and the drivers of value inside of the businesses and the drivers of risk inside of the businesses. So these are a number of the areas that we're going to be spending a fair amount of time with.
Chair Gensler, we want to thank you for being with us. Hope you come on back, because I do want to talk about climate. We have about 1 million questions about SPACs that we want to get to. I'll leave you with this. Are you going to be watching Saturday Night Live on Saturday night? And if so, do you have a message for Mr. Musk?
I don't know whether I'll be watching Saturday Night Live, but I have no messages for anybody that's on the show. I'm sure that they've got enough media consultants to advise them.
Chair Gensler, we appreciate you being with us, and we look forward to seeing you in person very, very soon.
All right, thank you, Andrew, Becky, and Joe.
You bet. Thank you.
When we come back,